Hey everyone, welcome back to the channel, your number one source for income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And speaking of high-yield funds, and one of my favorite types of high-yield funds, you guys already know that I absolutely love the all-in-one covered call ETF solutions. And today we're going to celebrate the 2-year anniversary of the original, the OG, the first ever all-in-one leveraged covered call solution. Of course, I'm talking about HDIV from Hamilton ETFs, the Hamilton Enhanced Multi-Sector Covered Call ETF. So what will we cover in this video? Well, let me review this ETF in case you're newer to the channel or newer to this ETF in detail. We're going to break it down. And after that, I'm going to go over my 5 favorite things or 5 important key aspects to understand about HDIV and why this is probably one of the most perfect and well-balanced, well-diversified funds that belongs in not only an income portfolio, but also for you growth investors out there as well. Let's find out why together right now. All right, everyone, let's break down the Hamilton Enhanced Multi-Sector Covered Call ETF together here. This is a Canadian listed fund. By the way, it's a Canadian listed ETF. Stock symbol is HDIV, delivering you more income every month. And by the way, if you're a veteran of the channel, you already know exactly what HDIV is. You could skip over this part using the YouTube chapters below into what I think are the 5 best aspects of this ETF, but this could be some great reminders as well because HDIV did do some changes recently. So what is this ETF all about? Well, the objective of the fund is to provide attractive monthly income and long-term capital appreciation. Right there, guys, whenever you see attractive monthly income first and capital appreciation second, you know that the primary objective is the income from a diversified multi-sector portfolio. So this is going to be a diversified fund, obviously, of primarily, not exclusively, primarily covered call ETFs focused on Canada. So the index, usually ETFs are trying to follow an index. So the index that this one is trying to follow, as you can see, it says diversification broadly similar, so it's not perfect. It's the S&P TSX60 index. So the TSX60, everyone, is kind of like the S&P 500 but in Canada. 60 top companies in Canada, which it makes up more than 90 or 95%, something like that, of the overall Canadian market. So you have increased growth potential versus owning the individual covered call ETFs. Higher yielding alternative versus broad-based index ETFs. That's a given. If you buy the S&P TSX60, you'll get something like 3% yield, whereas HDIV has actually over 11% yield. We'll check out the yield in a second. So it pretty much tries to follow the S&P TSX60 broadly. And another important aspect to this ETF, and one of my favorite things about it, which I'll talk about later, is that there is a modest cash leverage of 25% on the whole ETF. So basically, the fund manager will borrow 25% of the value of the fund. 25% is very, very modest and light leverage, everyone, to really enhance the income, the growth of the ETF. However, it does also enhance by 25% the volatility up and down. Let's not forget that. So first thing we want to see is what is actually inside this ETF. What does it hold? So if you go to overview, you scroll down at the bottom, you'll actually see the sector allocation mix. So a big chunk in financials, there's 13% in utilities, 13% approximately in healthcare, some technology as well, gold, energy. So very, very diversified in terms of sector, but we need to break down what's actually in the fund. And by the way, the management fees are very common, 0.65% rather management fee, which is very common for typical, covered call ETFs, but we'll discuss the fee a little bit later in detail. So this is the important part, guys. When you're investing in HDIV, you are investing in these 8 ETFs. So to find out what companies we're actually investing in, we're actually going to look at each of these ETFs in detail. But if you add up all the percentages, you're not going to get 100%, you're going to get 125%. That is that 25% leverage. So you're getting 25% more exposure overall with this ETF, which is great because the income is higher, the growth potential is higher. So if you're a long-term investor, leverage, don't forget, is typically always your friend. Leverage could be your best friend or your worst enemy if you're a short-term trader or investor, but if you're a long-term investor, because the markets go up over time, typically leverage is your good friend in this case. So Let's check out these ETFs together here. You have some ETFs that are actually Hamilton ETFs managed by Hamilton. You see that HMAX, HFIN, UMAX, and HUTS. These are actually Hamilton ETFs. So they got their own ETFs in here, but there's also other ETFs, covered call ETFs from other covered call providers, very popular and big covered call providers like Harvest, which has the HHL and HTA, so the healthcare and the technology exposure. You have the gold producer one from Horizons, and you have the energy giants from CI. So great diversification, not only, you know, with sectors and region, which we're going to see in a second, but also different covered call fund managers with kind of all have different covered call strategy. So it's really massive diversification in every sense of the word here. So let's take quickly a look at these ETFs. First, you have NXF, which makes up the biggest chunk of pretty much 20% here out of 125. What is NXF? Well, it's the CI Energy Giants covered call ETF. And in here, you have about 15 companies of basically the biggest oil and gas producers all around the world. You see that it is diversified in terms of region, and you will recognize a lot of the names. There are two Canadian names here, Canadian Natural and Suncor. These are actually the two biggest oil and gas producers in Canada, but you have BP, Total Energies in France. You have Chevron, ExxonMobil in the US, Equinor, Shell is another big one, EOG, ConocoPhillips. So really big, only the big boys here when it comes to oil and gas companies. So that's NXF. You have HMAX and HFIN. So HMAX is basically the top 10 Canadian financial companies in Canada. And if we scroll down, you'll recognize all of them if you're Canadian. All the big 6 banks are there, as well as Brookfield, Manulife, Sun Life, and Intact Financial. So about 75% in the big 6 Canadian banks here. This is not an equal weighted ETF. It's index based, so that's why you have Royal Bank and TD and BMO make up bigger chunks. So obviously, the bigger the company is, the bigger the financial is, the bigger the percentage is going to be. So that's HMAX. You know, of course, these are the trend you will see is that these are all quality blue chip companies. They also have HFIN. So HFIN is the Hamilton Enhanced Canadian Financials ETF. Very similar companies to HMAX. You'll recognize a lot of the same companies. The Canadian 6 banks are there, insurance companies. So a lot of the same companies as HMAX, except HMAX is a covered call ETF, but HFIN is not. HFIN does not use covered calls, but uses 25% leverage. So HMAX is kind of like the income for the Canadian financials, and HFIN is like the total return or the growth for the Canadian financials, which is held by 25% leverage. So obviously the yield is going to be smaller with HFIN, but you have more capital appreciation. So I find that was a really nice touch. You have the balance here of the Canadian financials income style and growth style, total return style. I thought that was a really nice touch. GLCC. This is a covered call ETF from Horizons. It's actually one of their most popular covered call ETFs, so over 200 million in assets. And like the name says, this has the biggest gold producers primarily in Canada. You'll recognize a lot of them: Royal Gold, Newmont, Barrick, Franco-Nevada. So you have all the gold, the top gold producers. There's about 15 to 20 companies in here with covered calls, which is why you got that nice 12% yield. Now you have HTA and HHL to cover this is another one point I'll talk about later, but in Canada, you don't really have much tech or healthcare, so I thought this was a great addition to this ETF. You have HTA, which is this ETF here from Harvest, a really good covered call manager in Canada. You have 20 of the biggest technology companies in here. So if we click on portfolio, you'll recognize a lot of the companies, everyone. Adobe, ServiceNow, Intuit, AMD, Apple, of course, Cisco, Microsoft, NVIDIA. So the chip makers are here, and also the software companies, all the big boys that you want to see. Facebook is here. All the big ones that you really want to see when it comes to technology, everyone. You also have HHL, right? That's the next ETF on the list here, which will take care of your healthcare providers, the top healthcare companies in the world. If we go on portfolio, again, you'll recognize a lot of the companies: Bristol Myers, AbbVie, AstraZeneca, Eli Lilly, Abbott, Amgen, etc., Johnson & Johnson, of course. And very, very important because healthcare is very underrepresented in Canada. So I thought this was a really nice mix, a really nice diversifier, both the technology and healthcare to get, access to what I feel are literally the two best sectors in the US, right? Healthcare and technology. Last but definitely not least, the last two is UMAX and HUTS. So these are, once again, like HFIN and HMAX, Hamilton ETFs. So UMAX is kind of like the equivalent to HMAX in terms of covered call strategy. And by the way, I do have a UMAX reviewed video, HMAX reviewed video if you want to check those out. I don't want this video to be 3 hours. So the UMAX is basically top utilities in Canada, whereas HMAX is the top financials in Canada. So UMAX is relatively new. You'll recognize a lot of the companies. Of course, you have the three biggest pipelines, right? Enbridge, Pembina, and TC Energy. But you also have the telecom, the big telecom. So Bell and Telus, of course. Is Rogers here? Yeah, Rogers is here, of course, as well. Waste Connections. You have the railroads too, which is a really nice touch. CP and CNR. And of course, you have a bunch of electricity companies like Emera, Hydro One, Fortis, Northland. So really all the best utilities, big cap blue chip utilities, very defensive sector in Canada. And then you have a small percentage, 4% in HUTS. And HUTS is like the equivalent to the HFIN. So HUTS has a lot of the same companies as UMAX, so utilities companies once again, except this is a growth ETF. It is not a covered call ETF. So you have, once again, just like the perfect balance of income and growth, HMAX and HFIN on the Canadian financials. You have it again on the utilities, Canadian utilities with UMAX and HUTS. So that in a nutshell, everyone, is HDIV, the ETF. This is what it owns. Now let's check out what I feel are the top 5 things or 5 very important, great aspects of HDIV. We're going to talk about the diversification, the flexibility, the performance, of course, because it's been 2 years. We do have performance numbers, and I think you will be shocked on how amazing this ETF has been performing, how that it's a hybrid. It's not a 100% income-oriented fund, right? It's a little bit of a hybrid between income and growth. And we're going to also talk about the leverage as well. So let's get into these 5 points together right now. All right, everyone, let's go over the 5 things I love most about HDIV, the 5 really important things that stick out to me with this fund. And hopefully after listening to these 5 things, you'll decide if this ETF is right for your portfolio. First of all, high yield and diversification. So my 2 favorite words in the English language, I think, or 3, high yield and diversification. So diversification, it's a no-brainer, guys. We've already checked it out together, right? You have sector diversification, you have financials, you have the energy, some gold, you have the very important tech and healthcare sectors that are underrepresented in Canada, and you also have some of the best utilities, which utilities include telecom as well in their pipeline. So when it comes to diversification, not only do you have sector diversification, which is very important, but also regional diversification. It's not only Canada, it's US as well. Actually, a pretty big chunk in the US and some international, because like we saw, there's some international oil and gas companies in NXF. So diversification, amazing here. Sector and region diversification. Yield, right? Yield. So right now, as I'm filming this on August 21st, the stock price of HDIV is $15.20. And if we look at the latest distribution, and by the way, we'll talk about that in a second, but HDIV recently did raise its distribution, monthly distribution, from 13.5 cents to 14 cents a month. So 14 cents times 12 is $1.68. That is the annual rate. If we divide it by 1512 times 100, you will get the annual yield, which is now over 11%. How's that for a really good yield, everyone? Over 11%. So diversification, sector, and region, plus very high yield. That's a unique aspect and one of my favorite things. That is number 1. Number 2 is flexibility, right? Active management. So what do I mean by that? Well, in case you've invested, if you invested in HDIV 2 years ago at the beginning, you will know that the ETFs inside of it was very different. It's a very different mix than it is now. So before, there used to be the ZWU ETF, which is the BMO covered call utilities ETF. Also the ZWB ETF, which is the BMO 6 banks covered call ETF. There was also FLI, which is just life insurance companies. FLI, by the way, is a covered call ETF for life insurance companies by CI as well, the same guys who do NXF. These have all been swapped out for Hamilton's own ETFs, HMAX and HFIN, UMAX and HUTS. Why is that really cool? Well, it's really cool that the fund manager, first of all, has the ability to do that, to swap funds for other funds for whatever reason, in this case, higher yield and more importantly, lower fees, right? Because if Hamilton puts their own ETFs in HDIV, they're not double dipping the management fee. So it's not like HDIV is paying HMAX a management fee. Hamilton is not paying Hamilton. So this, by doing these changes, it greatly lowered the management fees or the MER overall of this product. So flexibility is very, very important. The ability to swap out some ETFs for other ETFs, I think, is very powerful. Another example would be, what if one of these starts underperforming? What if there's a better, for example, technology covered call ETF, healthcare covered call ETF, energy covered call ETF? They could swap it out, right? So this is very, very good. They have the flexibility, and my hope is that they create more and more Hamilton in-house products so they could replace the non-Hamilton ones, and thus lowering fees once again. And by the way, if you have a question on the MER, if we look at the MER, it's this is as of the latest ETF fact sheet. Of course, it's going to be, this is as of this year, but it's going to be updated next year. It's 2.39%. You might be thinking, well, that's very, very high. Keep in mind, this is the MER, everyone. The management fee, that's what Hamilton gets, is actually 0.65%. The main reason why it's a lot higher than other ETFs is because of that leverage. So leverage does cost money, and the leverage cost, the borrowing costs, are included in this management, in this MER. More on that later. Number 3, very important, everyone, the performance. So let's finally take a look at the performance, because this ETF has been around for over 2 years now. So an amazing thing, and this blew my mind. So this is the performance versus XIU. So remember, HDIV is trying to track the TSX60. Well, XIU is the BlackRock S&P TSX60 ETF. It does exactly that. And HDIV, as you could see, the line in white versus XIU, the line in orange, has been completely destroying XIU, which is a representation of the overall Canadian market by a long shot. You see the total return there, 12.13 compared to 5% total return with XIU. This includes the income, of course. So HDIV, although it has much higher fees and MER, is beating XIU in terms of total return. Don't forget, this performance is after fees, right? So this was very impressive, but hey, the Canadian market, let's be honest, not that hard to beat. Typically, the American market beats it. So how is HDIV faring against the S&P 500 or the VSP? Well, I'm happy to report that HDIV is completely destroying also VSP. So VSP is the Vanguard S&P 500 ETF hedge, the Canadian. And as you can see, it's not even close. HDIV is also beating the S&P 500 ETF from Vanguard, the Canadian listed one. This actually blew me away, because it's very hard to beat the S&P 500. HDIV is beating it. How does it fare against another covered call ETF that focuses on Canada? This is HDIV versus ZWC, a very big and popular covered call ETF from BMO that covers the overall Canadian market. It's also beating ZWC as well. So when it comes to performance, everyone, it's absolutely incredible. Another thing that we need to remember is that HDIV has also increased their dividend 3 times, their monthly distribution. You see here, it started at 11.75 cents, then went up to 12.5 cents, then 13.5 cents, and now it's at 14 cents. So dividend increases as well. It's absolutely incredible. And don't forget, this ETF actually started with about a 16.50 net asset value and an 8.5% dividend yield target. And now it's way above that. You see the stock price is $15.12. Of course, there is volatility, and the overall markets have gone down lately. But even with this, you see that the NAV is staying very strong. And if you count all the income, this ETF has had a magnificent performance, like we saw, versus not only the overall Canadian market or XIU, but the overall American market or the S&P 500, which is absolutely incredible. Key aspect number 4 that I really love, this is very unique, because there are some people out there that do want a little bit of growth in their portfolio. They don't want to go full income. This is actually a great fund, because like we saw at the beginning, there are 2 growth ETFs in here. HFIN is not a covered call ETF. HUTS is not a covered call ETF. So approximately 18-20% of this fund everyone, is growth oriented or total return oriented without the covered call. So it's a great 80-20 approximately split between income and growth. I thought that was very, very interesting, very, very unique, because typically with these products, it's all covered calls or nothing. This one is a little bit of a hybrid. I absolutely love this. Great for you growth investors that are scared that you'll never get some growth. Well, you have a little bit of growth in here with two very important sectors in the Canadian market, the financials and a little bit in the utilities, which includes the telecom, the pipelines, even some railroads. So this is a great hybrid investment, thing to realize, because it's not full income. There is a little bit of growth in here. So high yield, diversified income plus growth as well, outperforming. What can I say? This is all great things. Last but not least, point number 5 is that 25% leverage. So this is awesome because this, first of all, this is an institutional big ETF manager in Canada. The borrowing cost that they get versus what we could get if we borrow money is much, much cheaper. So that's a big advantage. Advantage number 2, it's only 25%, guys. It's not a lot. Very, very, very modest. And number 3, you don't have to worry about being called away or anything or margin called. This is leverage handled by the fund manager. It's completely transparent. It's completely hands off. Very passive, another one of my favorite words. So I really think leverage is your best friend long term if you're invested in quality assets. And like we saw, this ETF does hold primarily all blue chip dividend stocks, blue chip stocks. That is really, really quality on both the Canadian and the US stock market. So those are my 5 favorite things about HDIV. I think this belongs in not only an income investor's portfolio, but also a growth investor's portfolio, because like we saw, it's a hybrid investment. So happy 2-year anniversary to HDIV. Congratulations to the guys at Hamilton. I think they're doing a really great job with this one. I'm excited to see what the future holds. But if the current numbers look the same, I think that this one is really going to be a behemoth, a monster. Right now it's beating XIU and VSP. It's beating the S&P 500 in the TSX60. So I'm super happy to have this one in my portfolio, and hopefully you now realize that it belongs in yours. So see you next time. Hey, don't go yet. A few reminders before you leave. Did you know that I launched a YouTube loyalty membership program where for only $3 a month, you could become a PII Inner Circle member, where you will gain access to exclusive content, exclusive videos and live streams, as well as other perks and benefits, including a really cool weekly opportunity report. That's right. If you're interested, just click on the little join button next to the subscribe button to see what it's all about. Also, make sure to follow me on Blossom and download Blossom. It's a social investing app, which is really cool. You could share your portfolio, follow other people's portfolios, including my own. My username is Adrian_PII. So download it with the referral link below. Not only is it free, but you could actually earn cash by taking these really small, quick 1-minute courses. Really awesome. It's a no-brainer. Also, make sure to visit our website, passiveincomeinvesting.ca. That's where you could book a one-on-one private coaching session with yours truly, with myself, where you could ask me all the questions you want. All the information and booking information is on the website. Make sure to check out that video on the homepage there to see how to book a one-on-one properly. Also on my website, you could purchase my digital product, which I'm very proud of, the Ultimate DIY Investing Package. This is a reference tool or a companion tool that will help you build your own portfolio. So it has lists of funds, it has sample portfolios, and it covers both the Canadian and US stock markets. And the good news is you'll only ever have to buy it once, because it comes with free lifetime updates. And my plan is really to update the version every single year. So make sure to pick it up. Also, I have Questrade and PASSIV referral links below. So Questrade is the broker that I personally use, and PASSIV is the broker companion tool or assistant that I use. Really cool program, really cool software. So I have referral links for both of those. Questrade, $50 of free trades. And PASSIV, I have half off for the Elite membership. If you're interested in the Elite membership, and even if you want to start out with the free membership and upgrade to the Elite afterwards, use my referral code so you could still get that 50% off. And don't forget that the Elite membership of PASSIV is 100% free if you use Questrade. For social media, we have a very successful and big Facebook group, private Facebook group with over 14,000 members where we all try to help each other out. So make sure to join that group. Information is below. We also have Instagram where you could follow us or more personal stuff when it comes to our life here in Panama. And there's LinkedIn as well. So as usual, everyone, how do I leave you? Continue to stay safe, stay healthy, and of course, stay passive. See you next time.